Welcome to our deep dive into financial ratios. In this video, we'll break down what financial ratios are, why they matter, and how you can use them to analyze a company's performance. Whether you're a student, investor, or business owner, understanding these ratios will help you make smarter decisions. We'll start by defining financial ratios and then move through the most important categories, giving you practical examples along the way. Let's get started by exploring the basics and setting the stage for a clearer understanding of financial health. Financial ratios are tools that help us evaluate a company's financial performance by comparing different figures from its financial statements. These ratios simplify complex data, making it easier to spot trends, strengths, and weaknesses. By looking at ratios, you can quickly assess profitability, liquidity, efficiency, and solvency. Think of them as shortcuts to understanding how well a business is doing. In the next scenes, we'll break down the main types of financial ratios and show you how to calculate and interpret them. Financial ratios are generally grouped into four main categories: profitability, liquidity, efficiency, and solvency. Each category focuses on a different aspect of a company's financial health. Profitability ratios measure how well a company generates profit. Liquidity ratios show how easily a company can meet its short-term obligations. Efficiency ratios reveal how effectively resources are used, and solvency ratios indicate long-term stability. Understanding these categories helps you know where to look when analyzing a business. Profitability ratios are all about measuring how much profit a company makes relative to its sales, assets, or equity. These ratios help you understand whether a business is generating enough income to cover its costs and reward its shareholders. Common profitability ratios include gross profit margin, net profit margin, return on assets, and return on equity. We'll look at each of these in detail so you can see how they're calculated and what they reveal about a company's performance. Gross profit margin shows the percentage of revenue that remains after subtracting the cost of goods sold. It's a key indicator of how efficiently a company produces its products or services. A higher margin means the company keeps more money from each sale, which can be used to cover other expenses or invest in growth. To calculate it, divide gross profit by revenue and multiply by 100. This ratio is especially useful for comparing companies in the same industry. A profit margin takes the analysis a step further by showing the percentage of revenue left after all expenses, including taxes and interest, are deducted. This ratio tells you how much profit a company actually keeps from its sales. A higher net profit margin means the company is more efficient at controlling costs and maximizing earnings. To calculate, divide net profit by revenue and multiply by 100. It's a great way to compare profitability across different companies. Return on assets, ROA, measures how effectively a company uses its assets to generate profit. It's calculated by dividing net income by total assets. A higher ROA means the company is making good use of its resources. This ratio is especially important for asset-heavy industries like manufacturing or transportation. It helps investors see whether management is efficiently deploying the company's assets to produce earnings. Return on equity, ROE, shows how much profit a company generates with the money shareholders have invested. It's calculated by dividing net income by shareholder equity. A higher ROE means the company is rewarding its investors well. This ratio is often used to compare companies in the same sector and to evaluate management's effectiveness. It's a favorite among investors looking for strong returns. Liquidity ratios help us understand a company's ability to meet its short-term obligations. These ratios are crucial for assessing financial stability, especially during tough times. The most common liquidity ratios are the current ratio and the quick ratio. We'll explain how each is calculated and what they reveal about a company's cash flow and short-term health. Knowing these ratios can help you spot potential risks before they become problems. Current ratio measures a company's ability to pay its short-term liabilities with its short-term assets. It's calculated by dividing current assets by current liabilities. A ratio above 1 means the company has more assets than liabilities, which is generally a good sign. However, too high ratio might indicate unused resources. This ratio is a quick way to check if a company can handle its bills and obligations in the near future. Quick ratio, also known as the acid test ratio, is similar to the current ratio but excludes inventory from assets. It's calculated by dividing liquid assets like cash and receivables by current liabilities. This ratio gives a more conservative view of a company's liquidity, showing whether it can meet obligations without selling inventory. It's especially useful for businesses where inventory may not be easily converted to cash. Efficiency ratios show how well a company uses its resources to generate sales and manage operations. These ratios help you spot operational strengths and weaknesses. Common efficiency ratios include asset turnover, inventory turnover, and receivables turnover. We'll break down each one so you can see how they're calculated and what they reveal about a company's day-to-day management. Asset turnover ratio measures how efficiently a company uses its assets to generate sales. It's calculated by dividing net sales by average total assets. A higher ratio means the company is making good use of its assets. This ratio is especially important for companies with large investments in equipment or property. It helps you see if the business is getting enough sales from its resources. Inventory turnover ratio shows how quickly a company sells and replaces its inventory. It's calculated by dividing cost of goods sold by average inventory. A higher ratio means inventory is moving fast, which is usually a good sign. This ratio helps you spot potential issues like overstocking or slow sales. It's especially useful for retailers and manufacturers. Receivables turnover ratio measures how quickly a company collects money from its customers. It's calculated by dividing net credit sales by average accounts receivable. A higher ratio means the company is collecting payments faster, which improves cash flow. This ratio is important for businesses that rely on credit sales, helping you spot potential issues with collections. Solvency ratios help us assess a company's long-term financial stability. These ratios show whether a business can meet its long-term obligations and survive tough times. Common solvency ratios include debt to equity and interest coverage. We'll explain how each is calculated and what they reveal about a company's risk and sustainability. Debt to equity ratio compares a company's total debt to its shareholder equity. It's calculated by dividing total liabilities by shareholder equity. A higher ratio means the company relies more on debt, which can increase risk. This ratio helps you see how much leverage a company uses and whether it's sustainable. It's a key metric for investors and lenders. Interest coverage ratio measures how easily a company can pay interest on its debt. It's calculated by dividing earnings before interest and taxes, EBIT, by interest expense. A higher ratio means the company is more capable of meeting its debt obligations. This ratio is important for companies with significant loans, helping you spot potential financial stress. Financial ratios matter because they provide quick, actionable insights into a company's performance. They help investors, managers, and analysts make informed decisions. Ratios can reveal strengths, weaknesses, and trends that aren't obvious from raw financial statements. By using ratios, you can compare companies, track progress, and identify areas for improvement. They're essential tools for anyone interested in business or finance. Use financial ratios effectively. Start by gathering accurate financial data. Calculate the relevant ratios and compare them to industry benchmarks or historical trends. Look for patterns and outliers that might signal opportunities or risks. Ratios are most useful when combined with other analysis tools like trend analysis or competitor comparison. Always consider the context and avoid relying on a single ratio for decision. While financial ratios are powerful tools, they have limitations. Ratios can be affected by accounting methods, seasonal changes, and one-time events. They don't tell the whole story and should be used alongside other analysis methods. It's important to understand what each ratio measures and what it doesn't. Always dig deeper and look at the bigger picture when making decisions. Financial ratios make it easier to compare companies, even if they're different sizes or operate in different markets. By focusing on ratios instead of raw numbers, you can spot which companies are more efficient, profitable, or stable. Always compare ratios within the same industry for the most meaningful insights. This approach helps investors and managers make better choices. Ratios are great for tracking a company's performance over time. By calculating ratios regularly, you can see trends and spot improvements or declines. This helps managers set goals and investors monitor progress. Always use consistent methods and data sources to ensure accurate comparisons. Tracking ratios is a simple way to keep an eye on financial health. Investors rely on financial ratios to evaluate potential investments. Ratios help them spot undervalued companies, assess risk, and compare opportunities. By focusing on profitability, liquidity, efficiency, and solvency ratios, investors can make more informed decisions. Ratios are a key part of any investment analysis toolkit. Managers use financial ratios to monitor operations, set targets, and improve performance. Ratios help them identify areas that need attention, such as cost control or asset utilization. By tracking ratios, managers can make better decisions and drive business growth. Ratios are practical tools for day-to-day management. Lenders use financial ratios to assess creditworthiness and risk. Ratios like debt to equity and interest coverage help lenders decide whether to approve loans and set terms. By analyzing ratios, lenders can spot potential problems and protect their interests. Ratios are essential for making informed lending decisions. Business owners use financial ratios to understand their company's strengths and weaknesses. Ratios help them manage cash flow, control costs, and plan for growth. By regularly reviewing ratios, owners can make smarter decisions and build stronger businesses. Ratios are practical tools for everyday business management. Different industries rely on different ratios. For example, retailers focus on inventory turnover while banks look at capital ratios. Always use the ratios that matter most for your industry. Comparing ratios across industries can be misleading, so focus on relevant benchmarks. This approach ensures meaningful analysis and better decisions. Common mistakes include relying on a single ratio, ignoring context, and comparing across different industries. Always use multiple ratios and consider the bigger picture. Avoid making decisions based solely on ratios and double-check your calculations. Understanding the limitations and proper use of ratios is key to effective analysis. Financial ratios are essential tools for understanding and managing a company's performance. By mastering the main categories and knowing how to use them, you can make smarter decisions and spot opportunities or risks early. Remember to use ratios alongside other analysis methods and always consider the context. With these tools, you'll be ready to analyze any business like a pro. Thanks for joining us on this journey through financial ratios.